Elon made Twitter bag holders into XAI owners and then SpaceX winners, turning a $44 billion disaster into a $1 trillion loyalty program. Three numbers tell the whole story: 25%, 45 billion, 1.25 trillion. By the end of this video, you'll see how those numbers connect, why it's brilliant, and how Elon Musk fundraises like a Marine. No investors left behind. First, the original mess. Back in 2022, Musk bought Twitter for about $44 billion. Not worth $44 billion, bought for $44 billion. And the timing was brutal because tech valuations were already rolling over. He didn't show up alone with a suitcase of cash. He brought a platoon. Larry Ellison reportedly tossed in about $1 billion, Sequoia roughly $800 million, Andreessen Horowitz, Fidelity, even Binance with about $500 million. Then the mission turned into a mud fight. Musk cut staff, rebrands to X, rewrites content rules, advertisers panic, revenue takes a punch in the face. In early 2024, Fidelity disclosed markdown implied X was down about 71.5% from the original deal price. That is not a dip, that's a crater. Now, a big chunk of the Twitter deal was financed with loans that ended up stuck on bank balance sheets, because nobody wanted to buy X debt when the story was getting uglier by the month. Imagine being one of the Twitter co-investors. You can't hit sell. It's private, it's illiquid, your money is trapped. Normally, in venture capital land, this is where the story ends. You take the L, you write it down, and you pretend it was strategic. But Musk doesn't play that game. His version is closer to, if you took fire with me, I'm coming back with the helicopter. So the question becomes, how do you rescue investors from a collapsing asset without admitting it's collapsing? Attach them to a rocket ship. In 2023, Musk launched XAI, and in November of that year, Reuters reported something that sounds small, but is basically the entire playbook. X Corp investors will own 25% of XAI. AI companies in the mid-2020s are like hot air balloons filled with investor FOMO. They float on vibes, narrative, and NVIDIA GPUs. And XAI moved fast. May 2024, a $6 billion Series B. $6 billion. The investor list reads like a who's who of please don't miss the next OpenAI. Valor, VY, A16Z, Sequoia, Fidelity, Prince Al Walid, and Kingdom Holding. December 2024, another $6 billion in a Series C, adding BlackRock, Lightspeed, MGX, Morgan Stanley, plus strategic participation from NVIDIA and AMD. XAI was stockpiling money and compute like it was preparing for a boss fight. They even bragged about building Colossus, a supercomputer with 100,000 NVIDIA Hopper GPUs, fully operational in 122 days. The investors aren't down 70% anymore. They're down on one piece, up on another, and psychologically, they're back in the game. And psychologically matters, because fundraising is basically confidence with spreadsheets. But Musk didn't stop at a life raft. He used XAI to change the official value of X. And this is where it gets spicy. March 2025. Musk announces XAI is acquiring X in an all-stock deal. The deal valued XAI at $80 billion and X at $33 billion, plus about $12 billion in debt, for roughly $45 billion enterprise value. Remember Fidelity marking X at something like $12.5 billion? This internal transaction values X, debt included, at around $45 billion. Fidelity has to mark what they think a third party would pay in a cold market. Musk can set a price inside his own ecosystem using a stock swap, as long as the parties agree. And why would they agree? If you're an X investor, you desperately want out of the crater. If you're an XAI investor, you want distribution, data, and a built-in user base. Musk sold that synergy story hard, describing the combination of data, models, compute, distribution, and talent. So the X investors get rescued into XAI. Their old, ugly shares turn into shares of the new, hot entity. So far, this looks like genius. But we are not done. Because XAI was not the final destination. XAI was the transfer station. The final destination is the asset everybody wants, but almost nobody can get. SpaceX. Fast forward to February 2026. SpaceX acquires XAI. Multiple outlets report the combined valuation at around $1.25 trillion, with SpaceX at about $1 trillion and XAI at about $250 billion. Some tracking services are calling it the biggest M&A deal in history, blowing past the old Vodafone management record from the year 2000. The SpaceX announcement calls the combined entity the most ambitious, vertically integrated innovation engine on and off Earth. Translation? Rockets, satellites, AI models, the X platform, and direct-to-device communications, all under one roof. Now, if you're thinking, how does an AI startup get to $250 billion that fast? You're not crazy. Just weeks earlier, XAI closed a $20 billion Series E, naming investors like Fidelity, Qatar Investment Authority, and others, with strategic support from NVIDIA and Cisco. They claimed over 1 million H100 GPU equivalents across their data centers and around 600 million monthly active users across X and the Grok apps. They're not just selling models, they're selling distribution at scale. So why merge into SpaceX? The official reason is orbital compute. Musk's pitch. AI is hitting hard limits on Earth. Power, cooling, land, local politics. His answer is to launch data centers into space, powered by solar energy, cooled by the vacuum, and connected through Starlink. The Washington Post reports Musk said Starship rockets would launch satellites with powerful computers to run AI software, predicting that within 2 to 3 years, the lowest cost AI compute could be in orbit. Other reporting says SpaceX has even floated an orbital data center constellation on a massive scale, potentially up to 1 million satellites. Yes, it sounds like science fiction, but it is also a financing story. Because if you can convince investors this is the next platform shift, you can justify a valuation that makes everyone's earlier losses disappear. This is the no investors left behind moment. The ladder goes like this. Step 1. You invest in Twitter and get punished. Step 2. You receive a 25% stake in XAI and feel better. Step 3. XAI buys X at a premium valuation and your crater gets filled in. Step 4. SpaceX buys XAI, and now you own SpaceX shares. You didn't just survive the worst deal, you got promoted into the best deal. That is loyalty engineering. And it creates a social pressure cooker. If Musk offers you a seat on this rocket, are you really going to complain about last year's drawdown? Or are you going to smile, salute, and ask where to sign? Now, is this fair? That depends on which side of the cap table you're sitting on. Because every rescue has to be paid for by someone, somewhere. Risk number 1. Dilution. When you do a stock swap at a generous valuation, someone is implicitly absorbing the old risk. If you're a SpaceX shareholder who never cared about X, you just inherited a social media headache and an AI cash burn problem. And that burn is real. TechCrunch reported XAI was burning roughly $1 billion per month. Risk number 2, governance. Musk has done internal mergers before. Tesla buying SolarCity in 2016 got sued as a bailout. The Delaware courts ultimately upheld the deal as entirely fair, but it was a reminder that founder-led empire and minority shareholder protections are not always best friends. Risk number 3. The physics are rude. Space-based data centers look great on paper, but the engineering is brutal. Launch costs, radiation, hardware failures, repair logistics, space debris, regulation. If any part of that timeline slips, the financial narrative has to carry the valuation longer than planned. Risk number 4. Valuations are not gravity-proof. Private valuations can levitate for a long time. Then reality taps them on the shoulder. If AI demand cools, if regulators clamp down, if Starship has setbacks, or if orbital data centers turn out to be way harder than the PowerPoint, the whole ecosystem goes from virtuous cycle to who approved this? And risk number 5, the retail investor trap. SpaceX is private. XAI was private. Most people watching this cannot just buy shares in a brokerage account. That scarcity creates hype, and products get wrapped, repackaged, and sold as access. We are already seeing it. Yahoo Finance has covered ETFs using special purpose vehicles to hold private company exposure, including SpaceX. MarketWatch pointed out public vehicles like Destiny Tech 100 and mutual funds like Barron Partners that hold SpaceX positions. None of that automatically makes them good or bad. It just means the market will always find a way to bottle the hype and sell it. So what is the lesson from the Musk Marine strategy? 1. In private markets, relationships are an asset class. Musk's investors are not just buying shares, they're buying access to the next deal. 2. Distribution is king. X might be messy, but it has reach. XAI wants reach. Combining them turns attention into AI adoption. 3. Ecosystem compounding is real. When you can move assets between companies you control, you can smooth the bumps for your investors. It's like rebalancing a portfolio, except you're rebalancing entire companies. 4. If you're watching from the public markets, pay attention to proxies. Public companies can end up with exposure through stakes, partnerships, or funds, but the exposure is usually smaller than the hype suggests. And 5. The bigger the rescue, the bigger the consequences if it fails. When the helicopter is SpaceX, the fuel bill is not cheap. So yes, Elon Musk fundraises like a Marine. He doesn't just raise money, he builds a ladder of missions, and the reward for surviving the last mission is a seat on the next one. No investors left behind. Unless, of course, you're the one who buys in at the top. Hit subscribe for more weekly compounding, and I'll see you next week.